you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar Investment Conference. I'm Emma Wall and I'm joined today by Cormac Weldon, Artemis US Equity Fund Manager. Hello Cormac.
How are you?
Very well, thank you. So we've had Janet Yellen come out and say that US equities look fully valued, and we've also heard you talk today in the Morningstar Investment Conference about how the fundamentals seems to support interest rate rise, which could be bad for the market. So those two things combined, does it mean it's time to sell US equities?
Well, we don't think it's time to sell US equities. What we're pointing out is there are risks there. And I think that's what Janet Yellen was doing. So she was saying US equities are somewhat fully valued. But we are living in very strange times where, relative to other asset classes, we could justifiably argue the US equities are cheap. So for instance, the same week that Yellen made that comment, we heard that the Swiss National Bank had been buying Apple. So we're living in strange times. Traditionally speaking, the first interest rate increase isn't really the time to sell the market. For instance, interest rates went up in '94. The bull market ended in 2000. That's the most obvious example. Obviously, it's somewhat self-serving, but I think what it means is the risks are somewhat higher, and we need to be aware of those. We need to be aware of emerging inflation. Is there an inflation problem out there? That one might make us change our mind. We don't think there is. We think the biggest risk in the world is still deflation, although we are starting to see some wage inflation in the US. So it's flagging a risk, but it's not the end of the market.
And of course, these fundamental changes don't necessarily mean bad news for the entire market. We heard Clive Beagle's talk earlier about a similar situation being created in the UK, and he was saying bond proxy stocks are going to be hit hardest by interest rate rises. Presumably this is the same in the US.
Yeah, we couldn't agree more. I mean, really, those stocks have been revalued higher and higher and higher because they're bond proxies and because interest rates are low and people looking for somewhere else to put their money to get a dividend. So within our funds, for instance, we are underweight utilities, we're underweight consumer staple stocks, REITs, real estate investment trusts, reasonable part of especially the small and mid-cap index, we're also underweight. Other parts of the market, we just think the more cyclical parts of the market, which are actually quite cheap, should do better. We still like technology, there's good value there, believe it or not, and good growth, which we think can come through irrespective of what's happening interest rates. So we think we would agree the interest rate signal and interest rate increases are important for how you structure your portfolios.
And what about the impact then on consumers? Because wage inflation is obviously positive for consumers and therefore positive for domestically focused stocks. But then the flip of that is if people are having to pay more on their mortgages, they have less money in their pocket.
Yeah, that's true, and that's really what Yellen has to judge, because that's exactly the dynamic. As wage inflation comes through, perhaps some consumer inflation will come through. People will be feeling pretty good about that. But is their mortgage going up? And obviously we know mortgages are set by 10-year rates, not short-term rates. But nonetheless, the cost of money isn't zero anymore, and that's part of what the Fed has to judge. We believe what they want to do now is to start to raise interest rates, but not have a negative impact on the economy. That's a delicate balancing act, particularly today, where it seems people are very skittish about interest rates going up. But I think the important factor about all of this is this has to be the most discussed interest rate increase in history. So that's good for markets because we're discussing it about the impact of markets. It's also good for consumers. They're thinking, do I borrow to buy a home? Do I take out a mortgage? Interest rates are going up. CNBC is telling me that all day, every day. So we think that just gets factored into expectations and therefore isn't the shock that perhaps sometimes we think it would be.
Cormac, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.